Another global outage, and this time it's Cloudflare.
Here we go again.
Exactly.
Yeah.
Websites slowed down, APIs just broke, whole platforms were freezing up.
And you get that reminder, don't you? Just how fragile the internet's backbone really is.
It's the plumbing for, a huge chunk of the modern economy. And when that plumbing breaks, you feel it instantly. SaaS, gaming, e-commerce, everything.
And of course, the market feels it first.
Oh, absolutely. Whenever the internet shakes, the stock market just reacts with this instant fear.
We're seeing it right now.
Yep. Cloudflare shares, they declined about 4.5% in pre-market trading this morning. And the cause? A quickly resolved issue with its dashboard and its APIs.
And that quick sell-off, it just triggers these immediate assumptions. Investors jump straight to churn, lost trust.
Or that big enterprise customers are going to start looking elsewhere.
Right. And Cloudflare, TickerNet, it just seems particularly sensitive to these little operational wobbles.
It does. And that brings us right to the parallel that I think every investor is thinking about right now.
CrowdStrike.
CrowdStrike. We saw a similar, maybe even more violent reaction earlier this year.
Oh, much more.
One issue from them, it broke Windows machines globally, and the stock dropped double digits in hours. The headlines made it sound like they would never recover.
But what's so fascinating there is comparing the type of failure.
How so?
Well, the CrowdStrike issue was a core security module failing. It instantly bricked client machines all over the world. It was structural.
Yeah,
You know-
right at the delivery system.
Exactly. This Cloudflare issue, while it's definitely critical and disruptive, it seems to have been more isolated to the dashboard, to the management APIs.
So the argument then is that this might be less existential, less likely to cause that long-term erosion of trust compared to a huge security platform failing at the client level.
Precisely. That difference is absolutely key if you're trying to judge the potential for a rebound. If the damage isn't to the core security promise, then the overreaction is probably temporary. So that's the real question today, isn't it? Is this panic just noise? Does Cloudflare just bounce back, or is this 4.5% drop the start of something, well, bigger?
And that's our mission for this deep dive. We need to look past that headline and compare the stock panic to the underlying financial health, the growth forecasts, and the valuation risks of Cloudflare.
Is it a dip to buy or a sign of deeper trouble?
Let's find out.
Welcome to FactsNotForecast, your daily edge in the stock market. Facts, insights, and opportunities you won't hear anywhere else. Okay, so let's unpack this. Before we get into the financials, I think we really need to appreciate Cloudflare's role in all this.
That's fundamental.
It is. It's a cloud services provider, basically an essential middle layer for the internet. It offers security like zero trust architecture and performance like content delivery and DNS.
That word critical is the key. Cloudflare isn't just another service. It's the infrastructure that sits between a user and the actual website.
And the zero trust thing, it's a huge shift in security. Right?
Yeah, it's a massive shift. The idea is you assume no user or device can be trusted by default. That narrative alone is driving just explosive demand for their products.
And we see that demand in the numbers. What's fascinating is that despite these occasional outages, the growth story itself is incredibly strong.
It's completely robust. The market isn't rewarding Cloudflare for what it is today. It's rewarding it for what it's going to be.
And that future is all about this zero trust adoption.
That, and they're moving into really high-margin areas, unlocking new opportunities tied to these huge tech tailwinds like AI adoption and the Internet of Things.
Those are massive long-term trends, and we can see that reflected in their past performance. Over the last 5 years, revenue has been growing at an average of, almost 30% a year?
29.7%, yeah. It's staggering growth for a company that's now doing over $2 billion in trailing 12-month revenue.
And they're doing it efficiently. That gross margin is really healthy at 75.2%.
Which tells you their economic model is strong. For every dollar of revenue, 75 cents is left after the cost of the service. That's a powerful position to be in, even while they're spending like crazy to get market share.
Okay, so the top-line growth is compelling. But that kind of rapid expansion, it often comes at a price. If the story is that strong, you have to ask, are they spending responsibly?
And that's where we pivot to the balance sheet.
Let's see how healthy this expansion really is.
This is where the story gets a little more nuanced. When we look at their financial health, they check 5 out of 6 boxes for us.
But there's one box that's unchecked.
Right. And it's their debt profile. That's the one that requires some context.
Okay, so tell us about the debt.
So Cloudflare has shareholder equity of about $1.35 billion. But their total debt is way up at $3.26 billion.
Wow.
And that has pushed their debt-to-equity ratio up a lot. 5 years ago, it was about 45%. Today, it's 242%.
Hold on. A jump from 45% to over 240%. By any traditional measure, that's a huge warning sign. How does that fit with a financially healthy company?
It shows a really aggressive shift toward using leverage. They are almost certainly using that debt to fund these huge capital-intensive projects like their zero trust and AI infrastructure.
So they're prioritizing growth over being conservative.
Exactly. Market dominance now, profits later. It's a riskier profile for sure, but it's pretty common for companies trying to win a massive new market like this.
I see. So it's a strategic choice, not like a sign of desperation.
I don't think so, no.
Yeah.
And the big mitigation here, the reason they still score well on liquidity is their cash position.
They have the money to cover it.
They have way more cash than debt. We're talking $4.04 billion in cash versus about $3.3 billion in total debt. They could pay it all off tomorrow if they had to.
And beyond just cash, their short-term assets at $4.5 billion are bigger than both their short-term and long-term liabilities combined, so no immediate solvency crisis.
Right, which then brings us back to profitability, because they are still technically a loss-making company.
Correct. Their trailing 12-month earnings are negative $103 million. But you said the trend is positive, which is key.
The trend is absolutely positive. They've been reducing those losses by about 9.6% a year for the last 5 years. They are on a clear path to profitability.
And that, combined with the cash, gets us to the cash runway discussion. Can they actually execute this plan before the money runs out?
And the answer is a definitive yes. Despite being unprofitable now, they have a stable cash runway for more than 3 years at their current cash flow level.
And free cash flow is forecast to grow
by 56% per year. So they have the time and they have the capital to make this big AI and zero trust bet pay off.
Okay, so this is where it gets really interesting for me, looking forward. The market is pricing in, just truly massive growth.
And that's the whole conflict for an investor right there.
The forecasts are just off the charts.
They are. Future earnings are forecast to grow at an incredible 43.5% per year.
43% per year.
Per year. And they're expected to become fully profitable within the next 3 years. Future return on equity is forecast to be a very high 28.4%.
Wait a minute. 43.5% a year. That just seems like an enormous execution risk. What are they seeing that suggests they can actually sustain that kind of growth that leaves zero room for error?
That is the gamble. You have to buy into the idea that their revenue is going to grow at 21.3% a year, which is already double the U.S. market average. If you believe that, then maybe the price makes sense.
Maybe. But that valuation risk is the huge counterpoint here, isn't it? Even with those glowing forecasts, the stock just looks incredibly expensive right now.
It absolutely does. Let's talk about the price-to-sales ratio. Cloudflare's PS is 35.5.
35.5 times their revenue.
Yes. It means you, as an investor, are paying $35.50 for every single dollar of their sales.
And just for context, how does that compare to the rest of the market?
It's an enormous premium. The peer average in their sector is around 16.5 times sales. The entire U.S. IT industry average is just 2.5.
So 2.5 times sales for the industry, and Cloudflare is at 35.
We are talking about a stock that is priced for more than a decade of perfect, flawless execution. That 4.5% dip today, it barely even registers against that kind of valuation stretch.
And if we look at something like a discounted cash flow analysis, which is just based on, fundamental accounting, it suggests a fair value of only $85.
And the stock is trading at $204.
Is the market just ignoring basic math here? Paying that kind of premium seems like pure speculation.
Well, that's the tension in the stock. The DCF model says it's 139% overvalued. It means the market is completely disregarding today's numbers and pricing in a future where Cloudflare dramatically outperforms even these wild growth forecasts.
So you have these two warring narratives, the aggressive growth story and the, frankly, insane valuation.
And the analysts are split too. The average 12-month target is $242, which is some upside.
But the range is huge.
The range is massive. It goes from a low of $117 to a high of $318. That wide dispersion tells you everything. This is a conviction play. You either believe in that 43.5% growth or you absolutely do not.
And just to add another layer of risk, what about the insiders?
You can't ignore it.
The people who know the business best, the executives, They seem to be selling.
Exactly. We've seen significant insider selling over the past 3 months. That includes sales by the CEO, Matthew Prince, in September, June, and February.
Now, that could be for personal reasons.
It could be. But when it's consistent like that, it definitely adds a skeptical layer to that really bullish story.
So let's bring this all back. Let's land the plane. How do we play this 4.5% dip? The market reacted fast, but the fundamentals, the cash runway, the growth, they all seem pretty solid.
The data tells a really clear but complex story. Cloudflare is not a struggling company. It's highly solvent. But its stock is priced as if it's already achieved all of that future growth.
So the final advice for you, the learner, really depends entirely on your own risk tolerance.
Absolutely. For a new buyer, if you believe in the long-term AI and zero trust story, and you're comfortable with that 35 times sales valuation,
Then maybe this looks like an opportunity.
it might. Similar to how CrowdStrike bounced back so hard, you're betting that the long-term potential is worth the short-term premium.
But for existing holders who are thinking about, say, averaging down or even selling.
You have to remember, this drop does not make the stock fundamentally cheap. That PS ratio is still enormous.
So averaging down is still pretty high risk.
Very high risk. Because the price is so tied to flawless execution, if they hit even one little roadblock on that 43.5% growth path, the stock could reprice very, very severely.
It's just like CrowdStrike. Sometimes the business stays strong while the stock just overreacts to a technical glitch.
And that 4.5% drop is probably just noise, but only if that long-term fundamental story holds up.
Which leaves us with the big investor question for you to think about. Does a temporary dashboard API issue fundamentally change Cloudflare's long-term competitive advantage?
Does it change its role as a key enabler for this massive transformation we see coming in cloud infrastructure driven by AI and IoT?
And if the answer to that is no,
If the answer is no, if the core plumbing is still sound and that enterprise business keeps growing, then today's panic might just end up looking like a real opportunity in hindsight.
appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.